the massive story of the next 10, 20 years is going to be the economic integration of Russia, China, and India together. And I know that right now that seems unfeasible. Everybody says, oh, but China and India don't get along. Remember that 15 years ago, Russia and China were at each other's throat as well. And meanwhile, you look forward to an integration of these three blocks where Russia provides the commodities, China provides the capital goods and the cheap funding because it's got the cheapest cost of funding in the world, and India provides the cheap labor because neither China nor Russia have cheap labor anymore. You integrate these three economies, you have an economic boom of epic proportions. The big question is, who does the funding? Who does the lending? In what currency? And here, the obvious answer for me is it gets done in Hong Kong dollars and with Hong Kong as a financial center. So essentially what we're going to see in the evolution of our global financial system is that just as in the 1950s and 60s, Europe recycled its excess dollars to London and helped create the euro-dollar market, we're starting to see the same thing where Asia is recycling its excess dollars into Hong Kong. Instead of a euro-dollar market, we're going to have an Asia-dollar market, but it's going to be based on the Hong Kong dollar, not the US dollar. And Hong Kong is going to have a boom that will be very similar to the boom that we've witnessed in London in the past 50 years.
Welcome to the Microscopic Podcast presented by Gold Republic. My name is Alexei Joronov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with some money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at Gold Republic, you will receive 1 free gram of gold. Just click on the link in the description. Welcome to the Microscopic Podcast, Louis. It's a real pleasure to have you. I have been following you since only recently, and I've only been coming across your name and your analysis in the past months. And I have to say that it's very refreshing because I think not many people actually have those views, especially eastwards, as you have, and still have, I would say, this intellectual honesty to it. So it's a real pleasure to have you on the podcast, Louis.
Well, thanks a bunch for the kind words. It's lovely to meet you. And thanks for having me on your podcast.
The first question I usually ask is, what is your most heretical view on the monetary system?
Oh, that's a super interesting question. Perhaps my most heretical view, or the one, I don't know if it's heretical or if it's off the beaten path, is that we're actually going through a very important transition in terms of China's own currency policies. So, first a little bit of backdrop. I live in Hong Kong. I spent a lot of time thinking, looking, investing in China. And really for the past, 12, 13 years, the big story for China was RMB internationalization, right? It was like, oh, we're going to do the One Belt, One Road. We're going to fund all these capital infrastructure projects with RMB loans. And I think 12 or 13 years in, they're realizing, maybe this doesn't quite work. Maybe this isn't the future, because if we keep going down this path, at some point we'll need to get rid of capital controls. At some point we'll need to make the renminbi freely tradable, and I think there's still a lot of reluctance for that at the top leadership in China. And so I think they've decided, well, we've got this other currency that we can use that is already freely tradable, and it's called the Hong Kong dollar. Look, I'm going to cut a long story short, and I'm sorry, I'm already very long-winded, but the massive story of the next 10, 20 years is going to be the economic integration of Russia, China, and India together. And I know that right now that seems unfeasible. Everybody says, oh, but China and India don't get along. Remember that 15 years ago, Russia and China were at each other's throat as well. And meanwhile, you look forward to an integration of these three blocks where Russia provides the commodities, China provides the capital goods and the cheap funding because it's got the cheapest cost of funding in the world. And India provides the cheap labor because neither China nor Russia have cheap labor anymore. You integrate these three economies, you have an economic boom of epic proportions. The big question is, who does the funding? Who does the lending? In what currency? And here, the obvious answer for me is it gets done in Hong Kong dollars and with Hong Kong as a financial center. So essentially what we're going to see in the evolution of our global financial system is that just as in the 1950s and 60s, Europe recycled its excess dollars to London and helped create the euro-dollar market, we're starting to see the same thing where Asia is recycling its excess dollars into Hong Kong. Instead of a euro-dollar market, we're going to have an Asia-dollar market, but it's going to be based on the Hong Kong dollar, not the US dollar. And Hong Kong is going to have a boom that will be very similar to the boom that we've witnessed in London in the past 50 years.
Wow, a lot to unpack, and I think
that's heretical enough? Is that heretical enough for you?
It's I think it's pretty heretical, and also there's obviously elements to the whole narrative of the money and the monetary system going more eastwards, which we will definitely unpack. So let's maybe dissect what you just said and start with China, which you also I think have tremendous expertise on. You've been in Hong Kong for a few decades, right? You have your fund there, and you also publish regular reports about the economy in China. And my first question to you is maybe also to give a bit of a background and a bit of a foundation for this conversation is to analyze how the economy in China evolved in the last 100 years from back then, coming out of this century of great humiliation to where we are today.
Look, I don't know how much time do you have, because 100 years is if we're going to go through 100 years of Chinese history. I'm going to have to do the super simplified version. Look, yes, China was torn apart. China was picked on by foreign powers, whether Japan, whether Western European countries, the United States, etc. And Mao Zedong, for all of his crimes and all the horrors, did manage to unite China. Having said that, he, economically, he was a disaster. And when Deng Xiaoping arrives in power in the late 70s, he realizes, okay, here I am. I have, 1 billion people. I'm the biggest, demographically, I'm the biggest country in the world, but globally, I'm a nobody. I'm a laughing stock. This desire that Mao had to control everything down to what people, wore to work, where people lived, where people ate their meals, has left us with an economy that's going nowhere. And so Deng Xiaoping's first step was to say, okay, I'm going to liberalize labor. I'm going to, tell people, look, open your factories here and come exploit our cheap labor. And that was really the first wave of Chinese growth, was all linked to labor liberalization. And so from the early 80s really to the late 90s, the growth was all about foreign companies setting up factories in China, and it was all about cheap labor. In the mid-90s to late 90s, the next wave was really about SOE reform. You had a period where essentially China pulled the plug on tens of thousands of highly unproductive companies. More than 30 million people lost their jobs during this period. It was a period of deep consolidation. And on the back end of that period of deep consolidation, China started to liberalize real estate. And that was the next big wave of growth. You had a bull market in real estate that lasted essentially 20 years. and drove tax receipts for local authorities, which then allowed them to invest in infrastructure. And that was a super exciting wave of growth. As this was going on, China also liberalized commodity extraction. Up until then, all the commodities had been run by the government, but China started to say, look, you want to run your own coal mine, you want to run your own copper mine, you want to go abroad and start buying commodities and trade them, have at it. So having liberalized labor, having liberalized land, having liberalized commodities, you come to the final frontier, which is liberalizing of capital flows. And this is where it gets very, very challenging because, liberalizing capital flows is a key source of the Chinese Communist, controlling capital flows is a key source of the Chinese Communist Party's power base. The fact that the party tells the bank, you're lending to this, you're not lending to that, really gives them all the power in the economy. So giving that up is a big challenge. And so, in recent years, I think we've had this sort of back and forth, sort of 3 steps forward, 3 steps backwards kind of thing, where it's like, oh, we're liberalizing capital. Oh, no, we're not. And that's more or less where, where we stand today. Having said that, the more recent past has been really determined by, I would say, China's deep, deep fear that the U.S. was out to get it, that the U.S. was trying to constrain China's growth. And that fear obviously came out of the 2018 decision to block semiconductor exports to China. When the U.S. government said nobody can sell high-end semiconductors to China, China thought, okay, if they're doing this today, tomorrow it could be auto parts, it could be chemical products, it could be any one of many things. We have no choice but to build resiliency on every single industrial vertical. And so the banks in 2018 were told, guys, normal loans to real estate. From now on, you're only lending to industry. And so fast forward to today, and by now, China is basically dominating every industrial vertical. It's producing better and cheaper cars, better and cheaper industrial robots, better and cheaper power plants, trains, subway systems, you name it, aside perhaps from the very top airplanes. China is competitive. Even at the very pinnacle of technology, namely AI, China has shown that it can compete. And so brings us to today where now the Chinese government can relax a little more. Now, it's funny because it looks like U.S. attacks onto China are amplifying right now, bigger tariffs, bigger trade war. But if you're China, actually now you have the option to respond to this through more domestic stimulus. Which I think is exactly what will happen. So, today as we record this, Chinese stocks got absolutely butchered today on the back of the back and forth on the tariffs. I actually think this is this is potentially a very interesting opportunity.
We'll touch definitely on that, the active ongoing trade war and also the tariff bloodbath that's going on today. But first, I'd like to know from you, how would you describe what China's intentions are in terms of as a projection of power globally?
So that's a tough one. Now, historically, China's not been into projecting power outside of its borders, partly because China's own history is a history of 5,000 years of China breaking up and getting back together again and breaking up and getting back together. And that just maintaining, I think, historically, if you've been the Chinese emperor, maintaining China in its geographical footprint is already a challenge enough that, China as a power has not been extremely, extremely expansionary. Now, having said that, there is no doubt that, Xi Jinping is an imperial-minded leader. And when I say imperialist, I don't mean that he's going to go out and invade the Philippines or Indonesia or Kazakhstan and say, okay, we own this now. But that the history of every empire is first and foremost the history of it's a road-building exercise. That's why, in French, we say all roads lead to Rome. And they say it in English as well, but all roads lead to Rome because what empires do is they build roads to bring in commodities cheaper to the heart of the empire, transform them into higher value-added goods, and then ship them out again. Now, through history, there's really two kinds of empire. You got the maritime empires, like the Brits up until 70 years ago, the Americans over the past 70 years, where you control the oceans and you bring commodities into the heartland, transform them, send out finished goods. Now, there's no doubt that this is Xi Jinping's worldview today. He keeps talking about the One Belt, One Road, the Silk Road Fund, the Asia Infrastructure Investment Bank. The idea is to tie up Southeast Asia, South Asia, Africa, Central Asia, all the way to Eastern Europe, to tie up all these countries to China's economic heartbeat. And that if up until recently all roads led to Rome, in the 21st century, all roads should lead to Beijing. And so, piece by piece, this is what's happening. I'm sure you've seen those maps where you look at 20 years ago, who was every country's biggest trading partner, and 9 out of 10, it was the United States. And today, 7 out of 10, it's China. So, the world is evolving in that direction. The reality is that, cars are a great example of this. China is today one of the more efficient producers of industrial goods. It's producing high quality goods at very affordable prices. That requires a lot of commodities. So that requires, a lot of infrastructure to be put in places that do produce commodities like Africa, like Central Asia. And, in reverse, these guys will receive Chinese goods. Now, from there, the question is, once this trade develops, does all this trade stay in US dollars? Does it make sense for China to go to Zambia, to go to Kazakhstan, to go to Uzbekistan, to build roads, to build railroads, to build gas platforms and pipelines, and to bring all that stuff to China, to pay US dollar for it, and then sell whatever, the cars or the extractors, the telecom switches, or whatever else you care to think, back to these countries in US dollars? It's not obvious, right? It's like, why should this trade be denominated in US dollars? And that goes back to the very first points that I made. I think over the long term, it probably won't be.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at Gold Republic. At Gold Republic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults, with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at Gold Republic, we offer real assets to safeguard your generational wealth. And also to that point, there's a lot of criticism, or at least a lot of people think as well, that this type of infrastructure investment with the Belt and Road Initiative is a way to subdue some countries into this kind of, just like the United States did with this economic hitman type of approach of indebting countries into ways that they can only default and seize their assets. Do you think that there's a biased, a very negative way of seeing it? What's your take on that? Like, how's reality?
Yeah, I was going to say, that sounds great on paper. Where have you seen it occur? The reality is, it's the old story. If you owe the bank $1 million, you have a problem. If you owe the bank $1 billion, the bank has a problem. If you lend a lot of money to Zambia, and then Zambia says, yeah, sorry, mate, not paying you back. What's China going to do? Send troops over to invade Zambia? It's, it becomes hard to do. Now, interestingly, we have a perfect example of the thesis right now, where if you look at Argentina, and you might have seen the headlines over the past week, but essentially Argentina has been staying afloat thanks to IMF loans, which are really controlled by the US loans, and China loans. And funnily enough, today it is the US telling Argentina, if you keep having China loans, then we're going to pull the IMF loans and the US loans. So it's, who's bullying who here? China isn't turning around to Argentina and say, hey, stop taking the US money. It's very much the other way around. So it's, I wonder to some extent when I hear these arguments, how much of that is a projection of how the Western world has behaved vis-a-vis emerging markets, and whether, whether there's, you are really going to see China, behave in that way. Because, the reality is that most of the international organizations, the IMF, the World Bank, etc., they remain completely, Western dominated. In fact, if you go back to 2008, when 2008 happened and the world hit the wall, China said, look, we can help. We have money now where, we're no longer the deadbeats that we might have been 50 years ago. So we have an incentive to stabilize the world. It's in our own interest. We're a huge exporting nation. We don't want the world to go down a tailspin. So, we can contribute more to IMF. We can contribute more to the World Bank, but we want a bigger say. We want voting. Proportionate to to our economic weight in the world and to the money we'd be putting in. And it was the Western world that said, no, we don't want that. We'll take your money, but you can't have a seat at the table. At which point China said, all right, well, if that's the case, I'm going to create my own institutions. I'm going to create the Asia Infrastructure Investment Bank. I'm going to create the Silk Road Fund. And I'm going to go out and, lend directly to emerging markets because, I'm not going to give money and not have a say. And, that's basically where we are today.
Yes, and also on that news, I think that they just recently also launched a global digital payment network bypassing SWIFT that also ties back to what you just said by creating a parallel infrastructure that more and more is less dependent on the dollar-centric institutions and network in general. If we look now at the economy in China, and that's also one of the things I was wondering, how do you usually, when you look at the economy, and it's a pretty, you could say, opaque way of looking at it in terms of data, how do you do that actually? How do you look at that and get information and data that you can actually rely on, knowing that it's something that you can use to gauge your own investment decisions and perspective on that?
So the first point I'd make when it comes to China is that I actually think that you can learn a lot by listening. That Chinese policymakers actually have, I think, a very strong track record of doing what they say and saying what they do. And that, again, if you take the time to really listen to what they're saying and to think about it, to put yourself in their shoes and say, okay, they're saying this, why would they say this? Let's, look at the world from their perspective. Then, that's the first step, because it does remain an economy where the capital allocation remains very centrally driven, especially at the banking level. It remains a capital control economy where the banks are the primary source of capital, and the bank's lending decisions are very, very heavily influenced by policy. So, in a world where when you're an investor, you have to follow the money. This is where the money is. This is how the money gets allocated. So, I think you get a lot by listening. And, that's why as a firm, we're headquartered in Hong Kong. I've lived in Hong Kong, as you pointed out, for almost 30 years. But we also have an office in Beijing. And, I try to go there at least once a quarter, spend time there, and, really try to figure out what's going on from a policy level. Now, I think once you have your policy picture, then you see whether things fall into place or not. You're looking for things that possibly contradict it, possibly go in the right way. And here, I always say that, when you study China, you can't expect to have a perfect photography or a very realist painting. At best, you have an impressionist painting. You get some data, you talk to corporates, you have some anecdotal evidence, you take in the policy view, and putting all this together, you get a picture that is, it's never going to be it's never going to be precisely right. What you try to be is approximately right, and that's a lot of the work we do.
It's the impressionist comparison. I think is pretty interesting one. When we look at now the changes that are occurring, and I thought it was very interesting in 2022, I think, or 23, when Xi met Putin and they were walking out, they said this famous phrase, right now there are changes, there are likes of which we haven't seen for 100 years, and we are the ones driving these changes together. I heard another podcast that this is actually a reference to the Qing dynasty's decline, where reformist general was basically formulating some concerns that it had about China, that was experiencing great changes unseen in 300 years, but this time it's a positive change. How do you project that? And now also, because you mentioned India and Russia just before, how do you see those three forces, those three nations, rebuilding this new world order? Exactly. How would that look like?
Look, I don't know what it's going to look like, but I do think, I like your analogy to the Qings. You could have also made an analogy to Lenin, who famously said, there are decades when nothing happens, and there are weeks when decades happen, which is what it feels is occurring right now. Look, I think that the biggest development of recent years, and I think actually most likely alluding to, is actually what's happened on the war between Russia and Ukraine. And if you remember, when the war started, the general perception in the West was, in the first few weeks of fighting, that we'd roll the Russian army decently quickly. That the Western weapons were of better quality. We'd flood Ukraine with weapons. Remember, people said Russia is a gas station masquerading as a country. That they were taking the microchips out of washing machines to put into weapons. That we could target precisely where the Russian generals were, and then within the first week, we'd already taken out 23 Russian generals on the battlefield, and so on and so forth. And the reality was that it was very true at first. And now I would point you towards a terrific speech by Eric Prince. I don't know if you know who Eric Prince is. He's the CEO and founder of Blackwater, basically the biggest mercenary organization in the world. If you build a gold mine in the middle of Zaire, you're going to get Blackwater guys to protect your engineers. So anyway, and he's a former Navy SEAL, and perhaps most importantly, he's very close to Trump. And now, in his speech to Hillsdale College, which in mid-February, people can look it up, Eric Prince says, look, the biggest development we've gone through is in the Russia-Ukraine war, we started off winning, and then Russia adapted. And Russia adapted to our weapons, which essentially means that a lot of our weapons are now obsolete. The Russian army has figured out how to counter them. That before, if you sent an artillery barrage onto Russia, you had an hour and a half before they figured out where you were. Now they do it in less than 90 seconds. So as soon as you fired off your missiles, you better be jumping on a Jeep and getting the hell out of Dodge, because you're going to get destroyed on the way back. So I highlight this because we can debate all day whether Eric Prince is right or wrong. But Eric Prince's main message is, look, the primacy of U.S. weapons is now over. Now, again, he knows about more than I do about these things. More importantly, he's very close to President Trump. Eric Prince and President Trump have been friends for years. So we can start off with the premise that Eric Prince believes this, since he's saying it publicly, and that, too, he's saying this to Donald Trump. Now, if you're Donald Trump and you're told, look, the primacy of U.S. weapons is now over, what concretely, what does that mean? I think it means that you have to fold back onto Fortress America, which is exactly what President Trump is doing. Essentially, you tell the Europeans, guys, you're on your own. I'm not defending you. Now, you make it look like, as you break up with them, like J.D. Vance did in Munich, you make it look like it's their fault. It's like, it's not me, it's you, kind of thing as you break up. And that's exactly what J.D. Vance's speech in Munich was like. Meanwhile, if you're in Asia and you're looking at all of this, you also think, okay, Lee Kuan Yew was right all along. Lee Kuan Yew would always tell Asian countries that were dependent on the United States. It's like, because Singapore also was dependent on the United States for years. Singapore was always very good at being friendly with China at the same time, because Lee Kuan Yew would always say, look, the United States won't be forever in Asia. China will always be in Asia. So make sure you stay somewhat friendly to China. And, frankly, the same story perhaps we should have thought of in Europe. It's like the United States won't always be in Europe, but Russia will always be in Europe. So this new reality is now confronting us in the face. The United States won't forever be in Europe. The United States won't forever be in Asia. China will always be in Asia. Russia will always be in Europe. And so this makes for a very, very, very different world. Now, one way to go about this is to say, well, I need to have an even more antagonistic relationship with Russia, an even more antagonistic relationship with China. I need to massively increase my defense spending. I need to build up a massive army. I need to be a military superpower in my own right. That's one possible path. The other possible path is to say, okay, I need to get friendly with these countries and do more trade deals and, try to find a win-win situation. Now, I think that this is actually easier to do with China, because China is actually trying to have win-win relationships with a lot of its neighbors, much more so than, say, perhaps Russia, that has a more contentious historical relationship with a lot of its neighbors. The reality is, China doesn't have a contentious relationship with Indonesia or with Malaysia or with Thailand or with any of these places. So there's no historical bad will, etc. Perhaps the one exception to all this is Japan, where there is historical tension. But that doesn't matter as much to the extent that China's economic expansion is going south and west. It's not going to the northeast. Like Japan lives off by itself, an island up there. It's not really the path of expansion of China anyway. So for me, that's the very important development in the world is that everything we've seen in recent months points towards the U.S. retreating onto itself. Points towards the U.S. essentially looking to build Fortress America. Essentially, saying to the rest of the world, the Americas is ours. We're going to take back Panama. We're going to take Greenland. Like, the American continent is ours, and the rest of you can just, bugger off. I don't care.
Yes, and that's, I think, a great segue onto what's happening today. I mean, today is Monday, the 7th of April. It's one of the craziest days in history in terms of stock markets. You have, I guess, a very busy day coming up today. And thereby also my question, Trump was tweeting recently about the Chinese retaliatory tariffs, that he would go on, and that just now I just see also that he canceled all the meetings to discuss any negotiations with China just I think an hour ago or so, and he threatens to even impose additional 50% tariffs on China by April 9th if the Chinese do not track back on that. You've wrote about this. You also wrote about the three objectives that Trump has with this. You've just mentioned this now, the Fortress America. How do you see this play out, and what are the current dynamics that are at hand here?
It's the dynamics are no good, because essentially now Trump is locked in with Xi Jinping in a face battle. Now Trump is obviously in a frame of mind where he doesn't want to be seen losing face. And I think Xi Jinping is the same. Now, I would say the big difference perhaps between the two is China has actually been getting ready for this battle for the past 8 years, essentially since Trump's first term. And uh, and the the Chinese exports to the U.S. are no longer that important to the Chinese economy. Far from it. I think China's big fear, coming into the second Trump presidency, was that the U.S. would build an anti-China coalition. That the U.S. would go to Europe, would go to Mexico, would go to Canada and elsewhere and say, hey, well, or like they're doing to Argentina right now, and say, hey, if you have any business with China, then we're going to cut you off and you can't do business with us. And if we ever moved in that direction, then it would be, that could be deeply problematic for China. But, today, Trump's ability to build any kind of coalition, I think, has been very damaged. It seems unlikely that such a coalition would come around. So look, I think China is now sitting back and saying, okay, you want to impose further tariffs? You want to do another 50%? Fine. We'll wear it. Let's see if you can. Let's see if how much people enjoy much more expensive iPhones, Nike shoes, etc. Because the reality is that, at least from a Chinese worldview, the biggest, and especially for this generation of Chinese leaders, that the biggest social destabilizer is always inflation. That if you end up with high inflation, that's when you have revolutions, that's when you have people very unhappy. And by the way, I think there's some truth to that. When you look at why did Trump get elected, you had a 12 percentage point swing amongst voters who earn less than $50,000 from Democrat to Republican. And the number one concern was inflation. And so, the reality is, if I think China's now saying, okay, you want to impose massive inflation on your people, let's see how long you last. And so the next couple of months, I think, are going to be very rough. It's going to be back and forth. But essentially, China has now called Trump's bluff and leaving Trump with two options: doubling down, and which the markets won't like, and or backing off, which would imply a loss of face for Trump, which is going to be very tough for him to swallow. So, no, look, these developments are not positive developments. However you try to spin them, they're bad developments for all.
What are the possible scenarios that you now see going from here?
Look, I think we're now in a full-on trade war. You're going through a big derating of equities. Now, what's interesting to me is that amidst this derating of equities, U.S. bonds are not doing well either. And so, the natural tendency, I think, when you're looking at equity markets that are down 20% or more or plus, is say, okay, do I buy this dip? And historically, the answer is yes, because as equities go down 20%, bonds go up 10%. So you have a lot of people that reallocate from bonds to equity. Now, here's the problem right now, I think, for the U.S. markets, is that if you're a balanced investor, if you're, Mr. Joe Schmo running 50% equity, 50% bonds, rebalancing every quarter, disciplined about it, and, for years and years this worked. The reality is that over the past 3 years, you're now down about 10%. And because for the past 4 years, you've lost money on bonds, and now whatever money you made on equity has just been wiped out. So you're actually now down 10% on your 50-50 rebalanced portfolio. And so you actually don't have profits on bonds to cash in to buy back the beaten up equities. What's fascinating over the past 2 to 3 weeks is as equities have sold off, bonds have done a whole lot of nothing. I mean, they've gone up a little bit, but even today they're actually down. And so this is a very, very different type of bear market that you're now seeing. And so, you asked me what my scenario is. Well, if you don't have the possibility to rebalance, where is the capital going to come from to push the bonds back up? And to push the equities back up, sorry. Where's the capital going to come from? It's not going to come from foreigners. So at some point the Fed will have to step in, I guess. But, when does it step in? It's probably in no rush to lift Trump out of the hole that he's dug for himself. So, yeah, it's not a great environment.
So that's like the standoff that we just mentioned about Trump and Xi is also the standoff that we can see with Jay Powell and Trump saying, hey, Jay, just cut the rates, put them to zero. There's a similar dichotomy here as well.
Yeah, except that, Xi obviously has to, he might have some political pressure from his Politburo saying, look, can we afford this trade war, etc. I think if you're Jay Powell, 99% of the Fed, of the people who work within the Fed, are very much of the feeling, let's stick it to Trump. I think what I saw once a poll, what was it, 90% of the people who work at the Fed voted for Kamala Harris. I don't think there's any rush within the Fed to come to Trump's rescue.
We might see then, in that sense, like this, since we don't know really where it's going, a bit of more prolonged bleeding in the markets.
Yeah, I fear it. And, interestingly, pre the election, J.D. Vance, had this long interview with Joe Rogan. Don't know if you ever watched it, but during that interview, he did mention, look, our big fear is that we come in and that we have a Liz Truss moment. That, the British Prime Minister who came in and started to say, look, I'm going to cut taxes. And the bond market started to melt down, and the Bank of England sat on its hands and essentially allowed the complete dislocation in the UK bond market and the UK equity market. And then she was promptly kicked off to the curb by her own party. Now, of course, in the US, you don't have that option of kicking the leader to the curb. It's not like, it's not a parliamentary democracy. So you can't really do that. But if it was, you would think, okay, another 10% down in the NASDAQ, and some of the Republican Party would already be throwing a challenge here. Like, they'd start to get a lot of the Republican, congressmen and senators would start getting nervous for their own reelection in 2 years' time. But of course, again, the U.S. is it's not a system, it's not a parliamentary democracy. But nonetheless, the Trump admin could be starting to face a Liz Truss moment pretty soon.
Mm. And you've just mentioned bonds before. We kind of see like the end of what a lot of people say is the end of the bull market in the bond market. The last 40 years is coming to an end. But that also begs the question of where is this then big liquidity safe haven gonna be? Then if the bonds can't make it, gold has seen a big rally in the last year alone, up to almost 40%. What is your thesis on that? Like, where do you see that develop?
Yeah, okay. Look, the bond bear market started 4 years ago, and to your point, I think there were a lot of factors behind the bond bear market. I think that the confiscation of the Russian assets was a huge part. It's like, well, if governments can take away my bonds at any time, then these aren't the assets I thought they were. I also think that the U.S. embracing massive easing of fiscal policy while unemployment rate was like lower than 4% was another factor. It's like, why the hell am I going to own bonds when the government is running, 2 trillion, 2.5 trillion budget deficits year in, year out, regardless of what the economy does. So there were lots of reasons, but for the first time in history, you have had 4 consecutive down years in bonds. So I think money has been leaking out of bonds for a while, and it's been going really into 2 assets. You mentioned gold. I think up until recently, there was a perception amongst a lot of investors that the Max 7 were the new bonds. It's like, I don't want to own you. I've got excess dollars. I don't know what to do with them, but I don't want to buy US Treasuries. So I'll buy Microsoft, and I'll buy Facebook, and I'll buy Amazon and Apple, because these stocks are liquid. I can always get out of them. They have pricing power, so they're actually better inflation hedges, and they're quasi-monopolies. So, I think the bond bear market started 4 years ago. What we're now starting is the Max 7 bear market, where people all of a sudden wake up to the realization that, oh, these guys have just spent $200 billion on building AI solutions that they'll never get returns on. Their AI investments are essentially write-offs at this point. And a lot of countries may start taxing them a whole lot more in this new trade war. These guys have benefited from very low taxes. I think Facebook's global effective tax rate is like 13%, and Apple's is like 15%. I mean, so all these guys are very much in the line of fire now, both from their own governments, from international trade developments, from their own investment decisions over the past couple of years. So I think that the big shift is not so much, okay, I don't want to own U.S. Treasuries anymore. That's already been the case for 4 years. To suddenly, I also don't want to own the Max 7. And so now, indeed, where do all these excess dollars go? So, gold is one option that's held up. Gold is one option, but the other option is simply, I just don't want dollars. Like I have these excess dollars and I don't want them anymore, and I'll just buy Brazilian reais, and I'll just buy, Japanese yen, and I'll just buy, whatever other currencies, euros, pounds, Aussie dollars, you name it. And, on this front, I think it's interesting that, amidst all this market meltdown, Latin American debt is actually holding up fine. Like you look at year to date, Brazilian bonds, now they had a bad year last year, but year to date, Brazilian bonds are up 14%, which in US dollar terms, which, is unusual for a period of stress in global financial markets. Usually emerging market debt, emerging market equities, that gets smoked whenever there's high volatility. It's Sir John Templeton's old saying that emerging markets are markets you can't emerge from in an emergency. But it's this time around, it's not proving the case. So I think we moved from I don't want to be in U.S. Treasuries, therefore I'll own the Max 7, to I don't want to own the Max 7, and in fact I may not even want to own the dollar. That's the phase we're now in.
That also marks a bit of the acceleration of the de-dollarization trend. And a lot of the, let's say, scenarios or projections are also focused around this new BRICS type of currency basket that was discussed for a couple of years already. Do you think that this is going to be maybe like marking that shift to this multipolar world of having this BRICS currency basket? Do you see that a reality or a fantasy?
Yeah, I don't buy it. Now, I'm not religious against it, but I just don't buy it. It doesn't seem credible to me. I think when I look at China, Russia for that matter as well, or even India, all these countries, I think they'd rather cut off their left arm than give up control of their currencies. Controlling your currencies, all these countries have capital controls. It's such a powerful tool if you have it in your toolkit. As a political leader, to give that tool up, you'd have to think you're getting something awesome in return. And, when I look at Modi, when I look at Xi Jinping, when I look at Putin, these guys are all control freaks. Like fundamentally, they're power hungry. They're very ruthless leaders. And they're not giving up control of their currency. They're not going to do a joint currency. Now, what they want to do, they want to move away from the dollar. That's for sure. They want to do more trade in a currency that is not the US dollar. The question becomes, okay, then what is that? Now, one possibility you could say is, China trades more with Russia, and that gets done in renminbi, and the excess renminbi then gets settled for gold, which is, a lot of what we've been seeing lately, and then that keeps so as trade grows between all these countries, if it all gets settled in gold, it keeps an undertow bid under gold. And that's one possibility. I think there's, like I mentioned, we started off, you said, what's a heretical belief that you hold on to? I think this my heretical belief is we're not going to get a BRICS currency, but instead you have China increasingly saying, look, here's a neutral currency that we can all use, the Hong Kong dollar. It's pegged to the US dollar, so you're not taking any true currency risk. But here we can trade in this without the U.S. Treasury saying, "Hey, I want to take a look at this trade because it's in U.S. dollars. Therefore, I can take a look into it." And so I think this is the path. This is the path of least resistance for me, much more so than creating a common BRICS currency.
But correct me if I'm wrong, but then if we look at the jurisdiction part of it, so the more legal aspect, that would still be tied to or seen as a proxy of China, or not?
Yes. No. Look, it's then you're tied to the Hong Kong courts, which, to your point, 10 years ago you could say, oh well, Hong Kong courts are very much independent, etc. Now, today, I would say Hong Kong courts are actually still very independent, except when it comes to matter of national security. And that was the whole point of the national security law. But yes, this might not leave people with a lot of comfort. Having said that, it's look, in recent years when BNP was slapped with billion-dollar fines for doing deals in US dollar with Sudan, when rules against Iran change on every different administration, you get different rules, etc. People might actually feel, what? It's not like US courts. I get tied up in there for 6 to 10 years, and it ends up costing hundreds of millions of dollars in legal fees. There is perhaps no perfect system. And if you're a country like Kazakhstan, like Uzbekistan, where do you fancy your chances more, in a Hong Kong court or in a New York court? Maybe if you're them, you're like, no difference.
Interesting. I think it's the first time I'm subjected to that hypothesis. We've reached the end of your available time, unfortunately. Maybe there's time for one last more question.
Sure.
Where do you see then the role of gold in all of that? As you just mentioned the settlement method, that this is already occurring. Do you see this growing, or do you see this maybe like being part of the system in terms of like regular transactions?
Look, I think the first thing we have to acknowledge about gold is that for 25 years, gold was, central banks kept selling gold. And really in the past, probably 6-7 years, a lot of central banks have become net buyers of gold. And this is, of course, the case of Russia and the case of China, because those kinds of countries no longer feel that comfortable being exposed to the US dollar and US treasuries. But it's also the case, Saudi Arabia has bought like $170 billion worth of gold in 2 years. And it's a case of a lot of, Indonesia, Thailand, Poland, lots of places have actually, central banks have been buying gold. And this is typically a political decision. And, central banks tend to be price insensitive buyers. They were price insensitive buyers on treasuries. It was them, buying treasuries at negative yields. When you're like, this is stupid. Who the hell buys treasuries at negative yields? It's usually not a private individual who wakes up one morning and says, I'm going to buy treasuries yielding minus, that guarantee me a loss of 20 basis point every year for the next 10 years. Like, nobody does this. Except, of course, when you're ordered to by political masters on top of you. So you now have central banks that are price insensitive buyers of gold. And the reason they're doing that is, the loss of faith in US treasuries that we discussed. And they're doing it because, the fear of growing US weaponization of the US dollar. And again, depending on which country you are. If you're France, if you're the UK, you don't have to worry too much about the weaponization of the US dollar. But if you're a country in Asia, in Africa, in the Middle East, or wherever, it could definitely be a concern. And so, for me, the big question mark for gold is, does the narrative change around US treasuries? Essentially, with Doge, with the attempts of, okay, we're going to be cutting the deficits, etc. Does it change the narrative on US treasuries? Interestingly, so far, it hasn't really. Most people look at it and say, okay, Doge, it's nice. It's a good first step. But really, what the US needs to do is tackle the runaway Medicare, Medicaid, Social Security. That's where the real spending is happening. And that's what's got to come down. But politically, this is very, very problematic. but I'm open-minded to it. And then the next big question is, do you get more or less weaponization of the dollar going forward? And here on this front, I think things keep getting worse. I sort of went unnoticed, but on his very first day, when Trump sent a plane load back of Colombian illegal immigrants back to Colombia, and Petro, the Colombian president, didn't want to take them in, Trump tweeted that he was going to put in sanctions on Colombian assets in the United States, including, and you can go back to his tweets. And I thought at the time, wow, so if you don't do exactly what he says, he confiscates your money. It's like, so I would say that on the budget deficit side, perhaps things get better. On the weaponization, I think Trump's instincts are pointing you in the wrong direction. Everything he's done so far has been very much a sort of, well, it's good for the United States right now. Who cares about the legal process, and who cares about the potential long-term consequences? None of which really is encouraging as a bondholder. Perhaps that's why, in spite of the markets collapsing, in spite of everybody telling you, oh my God, this for sure guarantees a US recession, perhaps that's why, bond yields are not cracking 4%.
Thanks. Merci beaucoup, Louis. We've reached unfortunately, the end of this time. I hope I'll have the opportunity to speak to you in the future and go more in depth in certain other topics. But I'm very grateful for this first interview. You're also on Twitter, and I would also recommend people to read your reports that your firm Gavekal publishes on a regular basis. Again, merci beaucoup, Louis. Any last words for rounding off this interview?
No, merci à toi. Thank you very much. Thanks to all the listeners. Feel free to reach out to me through Twitter. My handle is Gavekal, G-A-V-E, then Vincent. I look forward to hearing from people, and thanks for having me on.
Great. Thank you, Louis.
Thank you.